Hello, dear teachers and students. Welcome to your own YouTube channel, Learn Finance and Accounts. This channel is dedicated to the efforts put in by teachers and students in teaching and learning finance and accounts. In this channel, we will be discussing different aspects of these subjects in detail. Please watch the complete video, like, share, and subscribe to the channel to get more updates. Today, we are going to discuss about cost of capital. You often must have come across this term, cost of capital. What is this cost of capital? See, the cost of capital of a firm is the minimum rate of return expected by its investors. So, the people who have invested in the firm, whether they have purchased the shares of the company or they have given a loan to this company, they want a return. And this return is known as cost of capital to the company. Now, what is this? We are going to discuss this in detail. See, the capital used by the firm can be from debt, equity, preference share capital, and retained earnings. Let us know more about these four sources. The first source is debt. See, debt is a kind of loan. When you have to start a business organization, when you have to start your business, then you need money or capital. For the fulfillment of this requirement, which is of money or capital, either you can put it from your own pocket or you can go to a bank to take a loan. You can go to a bank, take a loan from a money lender, borrow money from a friend or a relative. So this is known as debt. Companies can also borrow money from general public in the form of debentures. So all these comprise of debt. The second source is known as equity shares. We also call this equity share capital, ESC. Now, what is equity shares? See, when a company requires money, the promoters of the company can put in money from their own pocket, or they can ask a friend or relative to join their business, become a partner, and the partners can put in their own money. But when the promoters of the company think that money can be raised from the general public, they go for a process known as initial public offer, IPO. You must have heard this word, IPO. We will be discussing about IPO in a different topic, in a different video. So through an IPO, a firm is able to raise capital. A company becomes a limited company and raises capital. And all the shareholders who have purchased the shares of the company become owners of this company. So equity shareholders are owners of the company, and this ownership means they are putting in some money for the start of the business. Operations of the business can be done from this money. This is known as equity shares capital. The company is raising finance or capital through equity shares capital. The third source of raising finance or capital is preference share capital. So when a company is new, it generally raises money through preference share capital. Now, what is a difference between equity share capital and preference share capital? See, in equity share capital, a return is given to the investors in the form of dividend. We all know that dividend is not fixed. It depends upon the profit of the company. And if the company earns profit, then it can distribute a part of this profit as dividend amongst the shareholders. Even if the profit is there, but the company is thinking that it will require further money for say expansion or increase in the volume of business, then it can keep the money with itself. That money is known as retained earnings, which a company retains. So dividends is not fixed. But now suppose the company is new, it does not have any goodwill in the market, or people do not know about the historical data of the company, whether the company will be providing a dividend or not. So they will not be risking their money by putting in money by purchasing the shares of the company. So they want a fixed return. Okay, either the company has a profit, it makes earns a profit, or it incurs a loss. Still, they want their return. So, in order to raise money, in order to raise capital, the company or the firm, what do? They offer a fixed return to the investors. Now, when the fixed return is promised to the investors, then they raise capital through issuance of preference shares. Now, preference shares have a fixed return. So, this is the third source of finance or capital. Now, the fourth source of finance or capital is retained earnings. We have already talked about retained earnings when the company is not distributing profit amongst the shareholders but keeping the money with itself for future requirements. Then that money will be called retained earnings. So, retained earnings are also a source of capital or finance. When the company is expanding, it requires capital, and this capital can be got by from retained earnings. So these are the four sources of raising capital or a finance. We'll be discussing these in detail one by one, and we will also be discussing how the cost of capital can be calculated. See, cost of capital from each of these sources are denoted by a different symbol. Cost of debt is denoted by KD. K is for capital and D is for debt. KD is cost of capital raised through debt. Cost of equity shares is denoted by KE. Cost of preference share capital is denoted by KP. And cost of retained earnings is denoted by KR. So these are different cost. But when a company is raising money through, say, all the sources, then how is total cost calculated? Now, total cost of capital of a firm from different sources is denoted by KO. Now, KO is also known as overall cost of capital. KO will be equal to KD plus KE plus KP plus KR. KO is also known as weighted average cost of capital. WACC, or weighted average cost of capital, and its calculation is discussed in detail in a separate video. So, cost of capital is the total cost that the company is giving to the investors for getting capital from them. Weighted average cost of capital is equal to cost of retained earnings plus cost of equity plus cost of preference share capital plus cost of long term debt. So, in our video, which will be coming after this, we'll be discussing one by one about the cost of capital from different sources. The first thing that we'll be discussing will be cost from. Okay, so this was all about the meaning of cost of capital. You are requested to support us so that we can continue making such educational content. This is all for today. This is all for this video. So we'll meet again. Okay, thank you.